So today at Glasses, we try to continue to evaluate what's happening in the market and looking at data sources from OEMs and from dealers and from leasing companies. And really what we try to do across all the markets that we work in across Europe and in Australia is to understand how COVID-19, and particularly for the UK, how Brexit is going to affect used car prices. Now there's a lot of pessimism about, and we'll talk a little bit more about the economy a little bit later on. But there are some positives. Now, even with asset values falling across most of the industries, we don't expect used car values to be quite as severely hit as in other European markets. And by 2022 in the UK, it's likely that used car values will improve to a level that we see in March this year. So let's look at what the realities are in the new car market. At the moment, the picture is fairly grim. The lockdown has decimated and really paused the retail market. And even year to date, we're down 48.5% versus 2019. June was lower than perhaps we kind of expected, but remember the Scottish, the Irish and the Welsh dealers opened up later in the month. So hopefully with July, there should be a little bit of more of recovery back to levels. Although for the whole year, we're still looking at quite a lower registration figure than in 2019, perhaps as low as 30% down. So for H1, the total registration stood at 650,000 units, obviously significantly down on the previous year. In terms of where the demand came from, private demand was relatively resilient and down only around 19% in June. It's really the business parts of the market, the business and fleet sales, that have been significantly affected and continue to be so. Really, with businesses pausing any spending amid budget reviews, we've seen that fleet sales have been substantially hit and stay 45.2% down on last year. So it's a real big hit in June. There has been some recovery, so year to date it's looking slightly better, but we are still waiting for the July figures and the August figures to come in to see some improvement. We think September should be strong, but it's still reliant on what happens this month and next month to see what really is happening in the future. If we look at the used market, and we'll look at the wholesale market to begin with, it kind of mirrors the new car market. June's auction sales have been smaller than they have been usually, but there have been significant increase in volumes and conversion versus May. So physical auctions closed in March and they haven't really reopened, but a lot of the volume that we're seeing now that's being sold is coming through online auctions. And those volumes continue to grow, and we're seeing real positives in July in both pricing and in volume, and those first-time conversion rates are really starting to get actually higher than they were a year ago. So that's kind of expected because the supply at the moment in the wholesale market is relatively low. So looking at volumes in more detail, January and February at the beginning of the year were actually relatively strong, and March, as we know, with the full lockdown coming into force towards the end of the month, they fell and really fell in April to really were decimated completely. But some auctions started to come back, and that's when we started to see some real changes in attitude perhaps to online auction versus physical, and buyers started to get used to how they could trust the descriptions of the vehicles, and also how the images were used by the larger auction groups to actually portray the vehicles in the best light possible. So a lot of the auctions now are the live auctions, the live online and the simulcast, but there are also the true online auctions similar to eBay, I suppose, that are offered by the groups, which is really helping push the volumes up. If we look at the first time conversion, and this is one of the figures we look at on a regular basis, just to see how strong the market is. And pre-lockdown conversion was high because the demand was high and supply relatively low. And in March, first-time conversion got up to 89%. Now it fell off in April to just under 40%, but May started to get stronger, and June is strong again. And this is for cars. So we've seen a real resurgence in demand But again, we've got to remember that supply isn't necessarily as high as we were expecting. And that supply issue is driven by the lack of part exchange vehicles coming on, because we're not seeing the new car sales happening in anywhere near the volume that really we should be hoping for this time of year. So we've got to just continue to move forward and look at how the market changes over time as these COVID distancing measures and opening up measures take their course over the next couple of months. What we also like to look at on the wholesale market is how the percentages of cost new, particularly on the fleet profile vehicles, is affecting how we value the vehicles moving forward. Now here, the one that's quite low and has actually recovered to more akin to the rest of the market are the EVs. So even EVs are starting to reflect and be closer to the percentage of cost new of petrol, diesel, and hybrid vehicles. But this really shows, for this particular profile of cars, is that the prices are starting to fall a little bit. There's a little bit less demand for these cars. Conversely, the older cars are starting to see more demand. Now again, they're the traditional trading cars that are perhaps 6 years old and over, and they're starting to see their values increase a little bit. And what we're trying to do in our values is make sure that we maintain that accuracy and look at how we can adjust the values relative to the market more succinctly and more accurately over time. What we also look at Glasses is the retail market, and we do this across all the markets that we work in. Now, what's been important over the last few months is kind of how retail has reacted, because retail tends to react significantly slower than the wholesale market to changes and factors affecting the market. So we look at the first little chart first. So back in February, the average known last sale price, so the proxy for what the vehicle sold for, was around £14,300, and already the last week in June had recovered to 14,500. So we're already seeing, although there were dips in May at the heart of the lockdown, the average sale prices have actually recovered quite quickly, and I'll show you a chart right at the end that actually we are recovering faster than any other European market in this respect. There is this pent-up demand that we've got to look at, and how long that demand will last is going to be significant in how the market ends up at the end of the year. In terms of the number of observations of sales that we see from the portals that we purchase data from, we take around the beginning of February as our first start of the index, so that's 100%. It fell significantly through March as the lockdown took effect, and down to single-digit figures, right the way through the end of March to the start of May. And then we start to see increasing. And actually, the last week in June rose back to the same level of sales as we saw at the beginning of February, which is amazing news for a market that we thought would take significantly longer to recover. In terms of average days to sell, this is a measure that most people use in the trade as we look at how long it takes to sell a vehicle over a period of time. Now, the average that we see is usually around 40 days. Now, that increased and started to increase all the way through lockdown to the height of around 90 days. But that too has started to fall significantly as we head towards the end of June. Obviously, the stock has been in stock at dealerships for a significant amount of time, so that it is taking longer for that figure to actually decline. But all in all, the retail dashboard that we look at on a daily basis is looking stronger and stronger as we move through July. Another figure that we publish on our own website is a figure that looks at how accurate we are each month. And this is readily available on our website, and actually in the PDF that we'll publish on the website when we close off any of the questions you give to us as we work through. Will be a link here just so that you can see the dashboard that we have here on accuracy. And really it's just to look at how accurate our trade values are directly against the same month's auction values as we get the observations come from all of the auction companies in the UK. We closely monitor the auction data because we use that along with retail data to set our trade values and understand where the trade and the wholesale markets are going. And they help us achieve that accurate trade value for you, the customers, so we can see what's happening. Now in June, versus the trade observations that we got within 0.9%. And we've been able to do this because we have stayed employed at Glassys. Everybody across AutoVista Group nobody has been furloughed. And because of this, we've been able to continue to monitor what's been happening right the way through lockdown. It's given a real indication of the likely stock that's available and how that's going to affect values moving forward. So just 0.9% above. And what we've also done is improved our standard deviation, so that the rest of the curves. So we've actually put more into so within 10%, or actually even closer for the majority of those valuations. You can see on this side, the blue line is where we have our trade value, the glass trade value, and the grey area is where the sale price actually is. So we are in line right there way across all of the age categories as the cars get older, and all of the price categories that are included in there. So very, very accurate for June. Another piece of data that we publish on the Glassys website are the fastest selling cars each month. Now this isn't just one shots, that we make sure that we look at over 50 observations for each vehicle that we add into these tables, because below that it's just a nonsense, because you may have a single car that could sell very, very quickly in any period. So we look at minimum 50 observations out of all the observations that we get every month and year, just to make sure that we're looking at the right kind of data and how that data is affecting used car sales across the UK. Now this month we've seen some slight differences because what people are really, it's an indication of what people are really trying to buy in the marketplace. They're not necessarily the cars that you'd want stock in your dealership, but it gives an indication of what people are looking for. So it suggests that people are searching for value for money. We can see this in the pricing, it's fairly obvious. But actually this value for money is driving the days it takes to sell. So 44 days, a number of Citroen C2s were seen, but they're driving the price down. So the original asking price was 1,400. This is average original asking price, and they're driving it down to 1,379. So not a huge decrease, but there's still negotiation in there. But what they're looking at are cars that are relatively old. This is 153 months, but actually have a relatively low average mileage. So they want something that's value for money. Don't mind too much about the age, but make sure the miles are relatively low for the age involved. I mean, there's some weird ones in here as well. We've got Focus C-Max, relatively large MPV, but they're selling relatively quickly. Now, does that suggest that delivery companies like Deliveroo are taking those cars, or that kind of thing? And the same with Nissan Pathfinder. Again, it's out of place in this area, which shows very much a change in how attitudes are at the moment to used cars. People are looking for value for money, and they're looking for something that fits in with what they do on a daily basis. So maybe people are looking for Pathfinders because they are a practical vehicle and you can get more into them. And that's the same across these two. Again, Seat Italia and Ford C-Max, similar segment car. Again, reasonable size, quite large volume, but relatively cheap and relatively robust in terms of a car. And then you've got the two small vehicles, the Chevy Spark and the Citroen C2, again delivering what people will want out of a car right now. And it may be that people want to move out of bus transportation, public transportation, into having a car, because that's the way they feel safest at the moment, because they don't want to be wearing a mask to work. They can get in the car, drive it to the car park outside work and get into work. So there may be changes that you need to take into account as we move forward, because your customers will be looking for different things out of the vehicles they get. Again, when I send through this PDF, you'll be able to access the monthly fastest selling data on the website, and you can look back at various other months and see what the fastest selling were in previous months. Prior to lockdown, The cars on there again drove value for money, but the average age was significantly lower, and people were looking for instance, Dacia Sandero Stepways tended to be one of the fastest selling cars on a regular basis. But at the start of lockdown, we were looking at Renault Zoe for the first time. Renault Zoe got up to the top of the list, and we've not had EVs on that list. So again, it's an interesting list. It's not gospel, but it is an interesting list to look at what the trends are when people are actually buying cars in the marketplace. Now, as a strong barometer of what the economy as a whole is doing, I've got just a few slides looking at the LCV market, really just to indicate again what's happening with LCVs and how that is affecting how we can see what's going to happen in the market over the next few months. Now, in terms of the LCV market, you see that year to date follows a very, very similar pattern. In April, if we just look at April versus April, the volumes were 86% lower than 2019 at just 3,387 units. May, again, hugely lower at 7,541 units, but June starting to come back to around 25% lower than 2019 at around 30,000 units. Some real recovery in June. And the market has stayed alive, and even on the motorway, we're starting to see more 20-plate vans on the motorways over the weekends that we've been allowed out. But year to date, it's still a very similar position to cars at 44.3% lower than 2019, and for the H1 or half year at 108,876 units. So there are significant changes in the marketplace, and we've got to keep our eyes on LCVs because they do drive a lot of what happens in the UK market. And because of that, it becomes a very important sector of the market to look at on a regular basis. Again, if we look at age profile that's selling at wholesale, so selling in the auction right now, we can see that volumes have recovered to what they were prior to lockdown, which is excellent news, and significantly higher than they were in June 2019. So January and February sales were very strong for the time of year, and we're forcing that because supply again was in short supply, and that was the case across all age profiles. As lockdown took hold, just like with the cars, the number of vehicles selling really dropped down to very, very low levels. But after sort of the middle of May, things started to pick up. Online sales become very prominent across all of the groups, and we're back to a stage where, well, actually, the way that the vehicles are selling is very, very close to how they were selling prior to lockdown. But we have to point out that most of the sales are online, and they are very reliant on how the vehicles are described and how they are imaged, because that just creates confidence and trust from the buyer to ensure that what they're seeing at auction is what is going to get delivered when they get delivered to their dealerships. We've also got to ensure that logistics are back online, and some of the figures that we've seen for registrations and for sales in June have been affected by logistical issues, possibly because some logistics companies have been a little bit slower, and of course it's much more difficult than selling a vehicle online. We're having to do face-to-face contact, and just following some of the health and safety measures, they're having to do this much more slowly. What we've also seen, if I just step back to the new market, we're also seeing in LCVs some of the larger fleets having issues doing the handovers, again because of the COVID distancing measures that have been put in place. So delivering a single car to a single customer in a known location is much easier for the franchise dealers. But when we're talking about 100-strong fleet to the post office or to a rental company, it's significantly different. A, the logistics have to be in place to be able to do that, but also B, the people have to be in place to be able to hand over those vehicles safely. And those measures will continue to be in place for the time being. And I think probably for the rest of this year at least, we'll see those measures in place, which will affect new car and new van sales especially. Just moving on to first-time conversion rate for LCVs. We're actually at a position where the first-time conversion has increased significantly, even above where we were in June last year. June last year is the blue line that we can see just intersecting the black here. So if we look at pre-lockdown conversion, it was around 84%, so very, very strong for the time of year, again, because of supply issues. With the full lockdown in effect, April fell to only 33%, and May recovered slightly to around 55%. But June, as buyers have got used to buying online, the support and the demand at auction has really increased, which is great news for the auctions. So what are we looking at in terms of forecast and moving forward? And we look at, you could be really positive, you could be really negative. So a half full, half empty glass, I suppose, if we look at that, and as sort of an analysis of what's happening in the marketplace. Now, working with my European colleagues, we've been able to put together a dashboard. And we use this on a regular basis, and we look at how that's been working across all of the markets. And you can get access to that dashboard as a demo, but I'll tell you more about those details a little bit later. But what I'm looking at in the UK is the sequence of events that we actually know about. 23rd of March, it was when everything kind of closed down, retail dealers closed, the wholesale dealers closed. But around the middle of April, trade online auctions started to restart. And from there, the volumes just started to increase, which is really good news. And then on the 1st of June, retail dealers in England opened, and through the rest of June, the retail dealers in the other parts of the UK started to open as well. It will be the July figures that really show how the market started to recover in terms of registrations. But let's just go back. So the 15th of June, physical auctions were actually permitted to reopen, but we haven't seen too many of those reopening, mainly because of social distancing measures, making the physical auction a more difficult environment really to actually sell cars in. Demand for new and used improved in June, and July we think should be a little bit better, particularly now that the other parts of the UK are fully open as well. But overall, for the whole year of 2020, we would suggest that around a 30% drop in volume of new registration and for used car sales, which is significant, but it is a climb back from where we are today, which is around 45% down on where we were. So we're seeing, we predict quite high volumes as we head into September especially, but then coming back off that total as we head into Q4 is likely to be a little bit strained, especially with the effects of the possible lack of jobs moving forward with the end of the furloughing scheme. If we see further reductions in the pound-euro exchange rate, new car prices will rise, which will also affect how people spend money on new cars, but could improve what we see on used cars. But from all the books and the stories that we see across all the news outlets and the forecast outlets such as Moody's, the UK is likely to suffer one of the deepest recessions across developed countries and across Europe. The GDP could drop as much as 11.5% this year. And remember, still around 9 million people, or around 30% of the workforce, are relying on the government to pay all or part of their salary. And that's costing £19.6 billion. There are more schemes being put in place by the Treasury to help the market kickstart, and those costs will again be a burden to the country as we move forward. And we could see in the longer term some taxation rises, but certainly we'll have to find some way of paying that back. Now at Autovista, we've looked at a number of different scenarios in terms of how the recession will affect our residual values in our forecast models and also in our reforecast on our monthly forecast and valuation models. And we're looking like the current risk of a deep recession with a relatively slow recovery is very high today. The worst risk, or the really high risk of a very deep recession and a very slow recovery is less so at the moment, but we'll know more perhaps as we head into October and the furlough scheme ends, and perhaps we'll see more unemployment moving forward. We're seeing that already, that on a daily basis, a lot of larger household brands are laying off significant portions of people, and that will definitely affect the demand for new cars and probably affect in some way demand for used cars as we head towards the end of the year and into next year. But it's not just COVID-19 that we've got to be mindful of. The impact of Brexit will compound COVID significantly. And remember, we still don't have a trade deal with Europe, our biggest current trading partner, and progress is very slow at the moment. There are some transitional arrangements obviously in place at the moment, but they will end at the end of this year, and it doesn't look like Boris's government are looking to extend those with the European Union. Many businesses that are already badly affected by COVID will be unable to withstand another shock. They will have significant issues coming back from whatever Brexit throws at them. Some British companies, don't forget, have already borrowed nearly £35 billion under the government coronavirus relief programmes. And if without a deal with Brexit, there is the possibility that the pound exchange rate could come back and be even worse than it is currently. Again, we're still at one of the lower points of the pound exchange rate. If it falls back to something close to parity, we will see significant price rises from the OEMs as new car stock costs more to import into the UK. Now, because of this, conversely, Brexit could support RVs. Now, we're trying to play with a lot of different scenarios here in terms of residual forecast planning. And there are issues abound. There are so many different variables. But what we're looking at in the UK is that in 2020, so this year versus March, earlier in March this year, that the values will only fall around 0.8%. It is next year that they will fall more. At this point, the recession will take hold, unemployment will be high, and we will know pros and cons versus what's happened in Brexit for the Brexit deal and for the trade deals moving forward. So we're suggesting that in 2021, the values versus March this year will be down 3.6%. But by the time we get to 2022, we're looking at some recovery versus where we are. So a real significant recovery in 2022. And hopefully we can get back on track to almost where we are today. Now, this is all caveated with lots of different things. And again, we could argue this, I think, between the people on the call, between me, between my team, and we could look at different values for different things. But this is where we're putting our stake in the ground at the moment, because this kind of makes sense. We could go beyond this, but if we look back at different recessions over different times, the UK has come out, particularly the car market, and the used car market in particular as part of that, has come out very strongly. Cars are required by most people to get to work. They're required today by even more people than usual because of COVID. So used car programs are in strong demand. We're looking at the values today, right now in June and July, that they are very strong at auction. So we think this year is very, very good in terms of where we're looking at by the end of the year. Yes, by the time we get to October, there will be issues as we head into the end of furlough. But next year, we don't think will be as bad as most people think, and used car values will stay strong. One of the main things here is we've got to remember the UK is an island. We drive on the opposite side of the road to most of Europe and most of the places where we import cars from. We will not have the supply of new cars that will potentially wanted by many of the manufacturers. So used cars across most of the age profiles and across most of the segments will be in strong demand. And that's why we've come up with this forecast. So what can you do next? How can you use our data? So one of the things I would always advise, it doesn't matter who you buy the data from, but data is key. And it's more key than ever at this point, because what we're looking at is such a seismic change in the market that without data to help you make decisions either at your OEM, at your insurance company, at your leasing company, at your dealership, you will not necessarily make the right decision, because that gut feel that perhaps you've used in the past isn't the right feeling, because things have changed so significantly. So what we can do to help you is that we have a number of things that you can use for free with the white paper. We have a white paper that covers the whole of Europe and looks at price indexes across all of the main European markets and some of the more minor ones today. And we can look at the segments, and we can look at the how vehicles are doing. So the chart below is just a simple screen grab from our system called Residual Value Intelligence. And a lot of the data that's in here is in the white paper. And you can request a free demo of RVI from Tim or from Paul, and I'll leave the contact details there for you, so that you can start to see what's happening in the market for the UK market versus the rest of Europe. But I think this is key. And it's not just key for the OEMs and big leasing companies, it's key for everybody, because we can see how the UK is actually reacting today against what's happened with COVID. We've got to be mindful of what could happen next with the end of furlough and with the end of the Brexit negotiations, or lack of negotiations, as we head into December. But let's be hopeful that the market continues to recover, because this is our livelihood, and this is where we know we can make the biggest change and the biggest differences. And by using the data that we have available for you, you'll be made to make the changes that you need to make, and those decisions. And it may be a trade-in, it may be that you're at auction, it may be an insurance claim, but that data that is available for you today is the most accurate data in the market. And just downloading the white paper, it's a 10 or 15 minute read, but it's quite interesting that you can see what's happening across the rest of Europe. So here we are in the UK. We've had a number of questions come in, and what we're looking at now is just to make sure that the market continues to look forward. Yes, lots have happened over the last few months, and what we've looked at is that a lot of data is available, and it's available for you today. And our data is there. That it's just we'll continue to the values, but we look to reflect what's happening in the market all the time. So as we get to know what's happening with Brexit, and as we know what's happening with the furlough scheme, we will change our forecast appropriately to ensure that we continue to reflect what's happening. So that's the end of the presentation. I'm just looking at the questions now, just to see what's coming in. And I'll just try and just go through some of the questions. So the first one that's come in, why do you think the UK market is recovering quicker than in the rest of Europe? Well, there are a couple of reasons around that, and one of them is that we are an island. We drive on the wrong side of the road, or the right side of the road, whichever one you look at. And the demand there, the supply coming in from the factories is going to be relatively slow to pick up. They will supply as quickly as they can, but we're seeing some shortages, and the logistical issues are starting to create that. Why the used car market is recovering quite quickly is that there has been pent-up demand. People still need cars, and those cars are available today to buy. And so that people are looking at those cars more quickly than perhaps looking at new cars. So that's why those prices are starting to recover quite quickly. For the second half of the year, well, we'll see that in June, we saw in June that the new car market started to recover. July and August should see some reasonable recovery now that logistical issues are starting to be sorted out. There's more logistical trucks really sort of ferrying cars to and from dealerships, and that's becoming much more positive. From a used car perspective, we're seeing that those cars are becoming available more freely. The supply, as new car sales go up, we should see more used and trade-ins becoming available at auctions, so the wholesale market should start to grow as well. Then that might, if supply starts to tip over the balance, we'll start to see used car prices coming down. But certainly at the moment, with the supply issues in place, the remainder of the year for used car sales is going to be relatively strong. So another question. Do you think buyers and sellers will return to physical auctions when they can? Now that is an interesting question. I spent many years working at BCA auctions, and they still haven't reopened their auctions, and neither have Mannheim. Some of the smaller independent auction houses have reopened properly. We have seen a couple of physical auctions from a couple of the bigger auction houses. Physical auction might go through a bit of a change, and we may see fewer physical auctions in the future. Online selling for these auction companies could be the thing of the future. I think buyers are starting to change significantly, and with their buying habits, they're becoming more trusting of the descriptions of the cars as they are sold in auctions, and the imaging of the cars has really improved over the last few months. We're seeing better images of the damage, because we've got to remember every car in auction is unique. It has done so many miles, it's got so much damage, and that damage may be minor, but it still affects the value of the vehicle. So we've got to be really careful in how we look at that, and how physical auctions change. So there may be I don't think it'd be a seismic shift to physical. We've got to just make sure that over the next few months that the auctions come back to business, and online auctions continue to work in the way they need to work. But yeah, that's a really good question. But I think it will be up to the auction companies to put in place the COVID-19 measures that they need to put in place to enable the customers to ensure that they are separated enough and social distancing occurs. Okay, that's all the questions that we've. Oh no, just one more. What is the biggest factor for recovery across countries? I think one of the biggest factors is really to look at where the confidence lies with customers. The customers coming in, the retail customers, certainly in June, coming into new car sales, have been relatively confident, and they've liked to the fact that they've been able to spend money. Holidays this year are limited. Foreign travel is coming back, the air bridges are in place, but people are still at home, still working at home, and maybe the cars are something that they can talk about, it's something that they can go out to purchase. So customer confidence, I think, is going to be one of the biggest ones. Money availability isn't. Remember in the last recession, 2007-2008 global financial crisis, money was not available. Money is the cheapest it's ever been in terms of finance schemes. So that is not an issue this time. The biggest issue for people will be confidence and whether they've still got a job at the end of the day. So if we start to see huge amounts of unemployment back to potentially 1980s levels of unemployment, that is going to be a big factor that will affect the recovery as we move forward out of COVID. I suppose another issue will be if we go back to what's happening in Melbourne in Australia at the moment, and I suppose close to home, in Leicester, that we go back into partial lockdowns. Again, it will affect people's confidence and how they come out and spend their money. But if we can put into place more sort of online buying for retail customers and online delivery, again to retail customers, and increasing that trust, customers will continue to spend money with you and buy more cars across the marketplace. Okay, thank you very much. If I just put back this slide, remember Tim and Paul will be very happy to take an email from you moving forward, and please ask them for a demo. Also, and please download the white paper. It covers all of the main European markets, including the UK, and looks in detail about how the market has suffered through COVID, but also how it's starting to recover moving forward. So thank you very much for your time. I hope to speak to you soon.